Welcome to Rational Investing. My name is Cameron Stewart, CFA. Thanks for watching the channel. All the likes and subscribes, I greatly appreciate it. This week, I want to dive into a stock. We haven't looked at a stock review in a long time, so we're going to pull one out of the cash flow club. This stock is growing at 18% annually. It's got strong free cash flow, growing earnings, great market positioning, low debt, and it may very well be well priced after coming down a little bit in the recent period. Let's take a look at the ASML stock, the Dutch-based manufacturer of the equipment used to make semiconductors. Now, this is the company that makes the shovel, selling it into a gold mine rush. So we want to back up and look at what does that machinery look like, what are the margins, how many can they sell, and if they can maintain that cadence, you could actually have a great business here that is supplying a long-term, robust, and expanding market. Let's dive into the cash flow club now, take a look at ASML, and unpack this value stock. All right, here we are in the cash flow club. David has recently posted a summary of ASML. Let's take a look at this stock and see what they're making. So their major product, right, is this TwinScan EX5000. It's an extreme ultraviolet lithograph system, the EUV, and this machine is as large as a cargo truck, but it makes 185 to 200 wafers per hour, and those wafers are used by the semiconductor manufacturers like Taiwan Semiconductor to make the processors that NVIDIA is selling for $250,000 per processor. Well, NVIDIA's got to shell out hundreds of millions of dollars to buy the machine to build their semiconductor. Well, it'd be Taiwan Semiconductor builds the manufacturing capability. But I think there's a very interesting opportunity here with this trade war that's going on, the repatriation of semiconductor manufacturing to avoid the tariffs that are going in place currently and then perhaps more in the future. It's really, really interesting. You have a new CEO of Intel. You've got NVIDIA looking to perhaps manufacture product. We have Taiwan Semiconductors making in Europe and possibly the United States. So all of those installations of capacity is going to require equipment, and ASML has a monopoly on the manufacturer on the equipment that makes these chips. They are the only people that makes this machinery that can manufacture the chips. So let's take a look at what they did. A financial outlook 2024, what's coming in revenue, $28 billion, 50% gross margins. So that means revenue less the cost to manufacture these machines. They keep 50% of that money. We'll get into more of that in a little bit. CapEx this year, almost 2 billion euros. I might say dollars here because I'm typically used to saying that, but this is all euros. And then revenue next year, 2025, 30 to 40 billion. That's above the 28 billion this year. So one thing to note when you look at the cash flow of this business is they are heavily influenced by their working capital changes because one particular machine is so expensive. They end up cycling up and down year over year as the sales cycle of it's not like selling an iPhone or a Coca-Cola where you're consuming a liquid that's $6 or so. No, we're buying multiple millions of dollars of equipment, billions of dollars of equipment, and companies will capital plan, and they'll go to the manufacturer and they'll buy the equipment for several years. And so the timing of how that cash is unlocked over time tends to cycle. So just because they're dipping in revenue, cash flow a little bit, could simply be the timing of when they recognize that revenue and not necessarily a dip in sales. So that's a key point here. We'll talk about it later. I like this slide here. It talks about their financial model through 2030. They're giving long-term guidance, which is greatly appreciated by the market. And we're going to see it's mostly baked into the forecast, but it is nice to see what they're targeting. Currently 28 billion euros, what they did in 2024. Revenue, they're looking for a range of 44 to 60 billion in euros for revenue. They've got the installed base revenue and they've got system sales. So as they sell new equipment, that equipment needs to be serviced, and you get this recurring revenue piece from an installed base of prior purchases that are coming back for, hey, this piece broke, I need it replaced. I need to upgrade this machine that I bought for the latest chips, but I don't have to place the entire machine. So it's service-based revenue that tends to be recurring. We love that. And then obviously your big system sales. Last year, 22 of the 28 billion euro was just the system sales themselves. So vast majority is selling the big pieces of equipment. Speaking of the installed base, you can see here 2020 installed base 3.7 billion euro. That grew 14% annually from 2020 to 2024 to 6.2 billion. They're expecting that to grow on an annual basis of 13% annually between 2024 and 2030. That's a great double-digit growth rate on a recurring revenue model baked into their system sales of these giant machines. Next slide is how they allocate the cash. We'll get into this when they dive into cash flow, but basically they've got R&D, which helps them develop new pieces of equipment, and then the CapEx that they're building out machinery or factories to build these machines that they sell to third parties. And you can see their CapEx here. They're really heavily investing in understanding how to stay ahead of the curve and make the latest and greatest machinery in the semiconductor industry. This slide shows over time the earnings per share growth as well as the gross margin that they're making on this installed base and the system-wide sales. So very interesting to note, gross margin, the red line, was averaging about 45% from 2014 to about 2019, and then took a dramatic turn up to 53%. That's almost a 10% move. What's that, a 10,000 basis point increase in the gross margin, which is rare. It's then maintained at about 51% going forward. That might revert down, and that'd be a one risk to the investment. If gross margin reverts lower, earnings would come down. But so far, they've been able to maintain that for 4 years running. And then EPS, you can see EPS absolutely go ballistic here. The white line from €3 per 3.2 euros per share to most recent 20 euros per share over that 8-10 year period of time, as the compounding effect of both earnings growth and share buybacks compound to give you that hockey stick curve. Right? We talk about trifectas all the time in this channel, and one of the things we look for is earnings per share growth and share buyback. So this is the first video I've done in a long time, so I want to redo some of the balance sheet analysis that we've been working on. Here you can see their balance sheet. The first things we want to do is you want to look at cash that they have outstanding, 2023, 7 billion euros just sitting in the checking account. That's fantastic. That's their war chest. That's what they use to pay payables. That's what they use to pay their employees. That you need that instant liquidity. AR, receivables. This is the number where they've sold systems, they sold machinery, but haven't collected the cash yet. So that's 4 billion euros. They've got finance receivable. That's basically them financing some customers. And they've got rounded out for a total current asset of 24 billion euros. One quick tip here. These are always ranked in the order of liquidity. So if you're wondering how they determine what comes in this order of list, cash, short-term assets, AR, inventory, how do they determine that order? It's order of liquidity. How fast can you turn it into cash? And total assets are just shy of 40 billion euros. Let's take a look at current liabilities, 10 billion. So they've got current assets, 24 billion. They've got current liabilities of 10 billion. That's 2.5 times coverage. Fantastic. Your current ratio is much better. Here 2.5 times, so they can easily cover these payments of that was non-current liabilities. Current liabilities is 16 billion. Still phenomenal coverage, 2-to-1 over the 24 billion of current assets. Long-term debt, $10 billion. Long-term non-current asset liabilities, 10 billion. Of that, long-term debt, 4.6. That's a nice number, very, very low. Very quick here, looking at the P&L. Revenue, $28 billion. You can see the recurring service revenue, $5.6. Gross cost of goods sales, $13 billion for a gross profit of 14 billion euro. This is the 51% margin that we were referring earlier. 14 billion euro profit on 28 billion of revenue. There's your 51%. What's left after that is basically two lines. R&D, which is how they get better at doing what they do, and the general and selling and administrative costs, your SG&A. Very low here. I love seeing this. 1.1 billion of admin costs. That's your legal, marketing, HQ, executive comp, all your salespeople, marketing, insurance, everything to run the business that is not the factory floor, everything else. Very low. And doesn't seem to move a whole lot year to year. So as revenue grows, as gross margin grows, that base stays the same. More profits are going to come to the owners of this business. That is called operating leverage, and you want to see that happen. That's fantastic. Then you've got your rounded net income and fully diluted shares outstanding. Let's go to your favorite statement, my favorite statement, the cash flow statement. Cash flow from operations. Remember, there's three statements here. You've got operating, investing, and financing. The three sections. Operating is how do they make cash from their day-to-day operations, the core business. And here they made 5.4 billion euros of cash, and you can see some inventory negatives here, 1.6, and they've got some contract assets and liabilities, 1.5 negatives. These are that working capital timing I referred to earlier. So one thing I do want to point out is you'll notice the cash flow here on the operating activity has come down 10 billion, 8 billion, 5 billion. That's declining operating cash flow. I think most of that is working capital timing. You'll see this contract asset and liability was a positive 5.5 billion, so half of this number in 2021. It was a large positive in 2022, and it reverted negative in 2023. So that's the timing of the delivery of assets and the receipt of cash. These cycle over time. We're kind of in the bottom of the trough. It should revert higher and go up as the sales they're booking currently begin to collect the cash on those sales. So that's one thing to keep in mind and to watch. Purchase of property, plant, and equipment, that's your CapEx. And then what do they pay? They pay dividends. Here's your dividend payment, 1.3, 2.5, and 2.4 billion euro. They're buying back stock, actually a lot of stock. That's great to see. And then there's really not much else. So all they make positive cash flow on their operations. It's coming down a little bit because of the cycling of when they sell and receive cash, but it's still positive. The CapEx that they invest in the business is less than the free cash flow they generate in all 3 years. So that's fantastic. They have very little debt to pay off, and they can pay a dividend very easily. So I think the cash flow here is strong. Let's take a look at some of the charts and look at some relative value metrics. This is a fun one, just total return on the stock since it IPO'd in 1995. So you can see 95, it's sub a dollar in terms of dollar value, and it's now trading almost $800 a share, a really meteoric rise. If we look at this as a percentage, total gain is about the 75,000% return on a total gain had you held this stock. And that's why we always talk about buying a stock and holding it for a decade, because the vast majority of return you're going to get is in the tail end of your holding period. Think about, the old analogy. Would you rather have $1 million today, or if I gave you a penny and doubled it every single day for 30 days, which would you choose? Right? You'd obviously choose the penny doubling every 30 days, because that is going to be worth a whole lot more than $1 million in 30 days. Why? Because that last few doubling, the 28th day, the 29th day, and the 30th, that doubling grows exponentially. And that's exactly why you want to hold a stock for 10, 15, 20 years. That last turn is hugely impactful. You can see this also in Buffett's net worth. the last 10 years of his life, 15 years of his life, the vast majority of his $100+ billion fortune has been generated in those last few years. So here's a nice 200-day moving average. You can see the stock is dipped below the moving average a little bit. Might be an interesting time to pick this stock up. I think it's cycling as a result of kind of the sales and timing of cash. Hopefully it reverts higher and keeps the trend going. Here's a nice one of the quarterly EBITDA numbers. So EBITDA is our representation of operating profit or enterprise level profit. You can see it grew very slowly in 2014 to 2019, picked up dramatically in 2020, like post-pandemic, and has grown considerably. And there's a little bit of timing here. They have some quarters where they dip. They have some quarters where they rebound. You know, again, this is why we don't really judge stocks on a quarterly basis. You really want to zoom out for a long time. This is a good chart. People talk about dividend yields all the time, and they measure stocks and what they pay in dividend, but they forget to add the share buyback or the money that's used to buy back shares. Here it's very interesting. The blue is the dividend that they're paying out. The orange is the share buyback. And you'll see the share buyback is significantly larger than the dividend you receive. So be very careful if you judge stocks just on the dividend yield. You are ignoring the cash they spend in buying back their own shares. Okay, now as always, the cash flow one page. I want to dive in here and just take a look at the numbers, show you a detailed review of the stock. So let's take revenue now. For the last decade, 2014 to 2023, revenue has grown from $7 billion to $30 billion. These are in USD. Going forward, EBITDA, or that's enterprise earnings, $2.2 billion to almost $11 billion of profit. That's an 18 and 19% annual growth rate over that time frame. Very significant. For the most part, positive growth every single year. There's not one year here that dominates. So we like to see that. The level of debt, $1.4 billion, has grown to $5.5 billion. Still extremely reasonable. Excess cash, we're not saying that they have too much excess cash of the $7 billion we saw earlier. Market cap and enterprise value, last stated, just shy of $300 billion. We like to look at a couple of relative value metrics. So enterprise value to EBITDA and debt to EBITDA. Let's take a look at debt first. Debt to EBITDA is 0.5%, and it's been sub 1 almost the entire decade, with one instance where it's 1. This is where you're looking for a stock that's got low debt. Why? Because you as an equity investor are at the bottom of the capital stack. You're the last in line in a bankruptcy court to get any of your money. And if you have no debt in front of you, then the assets of the company are basically yours in court, but you get the upside return like a stock investor. So that's really critical. We love to see that 0.5% is a very, very healthy, low debt company that checks the box there. The enterprise value to EBITDA relative value here, it got inflated. Not gonna lie, in 2020 and 2021, I think the market got ahead of itself. 36 times, 40 times enterprise value to EBITDA is high for a large manufacturing business. It's come down to 27 times from the 40, almost halving. This number was 16 times and 20 times earlier in the decade when growth rate was a little slower. So I think there's a little risk here that the market multiple comes down slightly. But for a company that's going to be growing double digits in the future with a growing service revenue as a component of sales, to pay slightly north of 20x is not unreasonable for a business like this. All right, let's dive into cash flow. I referenced operating cash flow before. There's the $5.8 billion that we had in operating cash flow. CapEx 2.3. Your debt is very low. So one thing I want to show here is that your cash flow from operation, your adjusted cash flow from operations, we take out stock-based comp, is growing at 6% annually over the decade. That's very close to the 19% on the income statement with EBITDA. That means your cash generation is following the income statement, and the accounting team is not playing monkey with the numbers. That's a great check. Your income statement and your cash flow statement are growing in the same, or going in the same direction. If one was going up, one was going down, that'd be a red flag. If they go down together, they're still losing money, but at least the accounting team isn't playing monkey with the numbers. You want those two numbers to always be moving directionally the same way. But what this says is, hey, last year we made $5.8 billion of cash running our business, selling these machines, doing the servicing, paying our employees. At the end of the year, there was 5.8 billion cash sitting on the table. And they said, hey, what are we going to do with it? Well, we're going to take off 2.3 billion, about half of it, and we're going to reinvest it in our business. We're going to build more manufacturing capability. We're going to upgrade our manufacturing lines. We're going to increase software that we use. We're going to reinvest in the business. We have no debt, so there's no bank payment to make, relatively small, very, very small. So the rest of that passes through to the ownership. That's you and me that own the stock. And you get $3.7 billion of cash flow to equity. Now, this is exactly what a business is based on. You buy a company as a shareholder because you want the cash flow from the business. This number, this $3.7 billion is how you value this company. And this cash flow has been growing at 14% annually over the last decade as an average annual growth rate. That is a market-beating growth rate of free cash flow to equity, which is very, very good. There's no funny business there. They're growing that number of free cash flow. How the market responds to this is the multiple, but underlying the business is profitable. It's making good cash flow. Its earnings are strong. It's got low debt. And it's growing revenue. So then what do they do with this money? Well, they buy back shares and they pay a dividend. The share count has come down about, looks about 10% over the decade. So 440 million shares outstanding to just under 400 million shares. That's a 1% annual removal of shares. Fantastic. I've got a free cash flow share yield here, relatively small, single digits. You expect that for a company that's got a growth multiple of 27 times. But overall, I think this is very, very strong. Let's take a look at the forecast and figure out what do we think this stock is worth in the future. And if you bought it today, held it for a decade, what would you make? We've got two methodologies here. We've got the EBITDA market multiple method, and you've got your free cash flow method. Let's take EBITDA. So we've got a little dip in 2024 on profitability, and it rebounds as over long term, we're assuming an 8% annual profit increase, which I think is a reasonable number to assume. They've been growing at 19% annually for the last decade. We're saying, okay, they're going to grow less to be more conservative, 8% out the next year for the last decade. And we're going to apply 24 times EBITDA market multiple on that, which is a little lower than what they're currently trading at. That gives me a stock price of $1,400 out a decade from now. If you do the cash flow method, I'm getting $8.58 per share free cash flow. That's going to grow roughly 9% over the long term. I get $26 of free cash flow they're going to make a decade from now. I put a 2% free cash flow multiple on that. Again, just using kind of historical multiples here. And I get a $1,300 target. So we have two targets, $1,400, $1,300. They are guesses. We don't know, but they're a reasonable assumption about the future. So we have a price target. Now, what can you buy the stock for today? Let's go to the stock market and let's figure that out. I can buy as much stock as I want right now for $726 a share. I think in 10 years, that $700 is worth $1,300. It's basically doubling, almost doubling in shares. And over that time frame, I'm going to have a pro rata share of earnings. They're going to buy back shares. They're going to pay me a dividend. I'm in a business that basically has a monopoly on the greatest semiconductor manufacturing machine available on the market currently. And semiconductors is in a market that's absolutely on fire with crypto, with defense spending, with this technology I'm using here and AI to run my channel. Like all of that is the future. So you're in a pretty decent position for a business, and you're not paying the 100 times, that's right, 100 times earnings multiple on an NVIDIA. You're buying earnings at 20 times, from a company that has a monopoly on what NVIDIA needs to make their products. So I think there's a better way here to strike value or to participate in the AI boom rather than the semiconductor the processor maker like NVIDIA's, but to go upstream and buy the people selling the machines to make it all. Anyways, I digress. If you bought this stock today for $720 a share, you held it for a decade, you got pro rata share of this cash flow, and you sold it for $1,400, you would make 9% annual return on your money. That's basically a market return over this decade. Not bad for a company that is has relatively low debt and what seems to be pretty decent upside. I think there's a little risk here where this market multiple could come down. If it came down to where it was pre-COVID, you're looking at basically a 20 times market multiple. We're saying 24. But you're not buying it 40, you're not buying it in 30s. I think there's more upside here than downside. So it's a very interesting stock. Take a look at it. I give you a little distribution curve down here. So if the stock moves after this video, you can come back and take a look. Hey, it's at 650, that's a 10% return. It's at 580, that's a 12% return. And that's 12% every single year for a decade. Now I'll remind you, you don't need much return to beat the market. The market should do about 10%. If you do 12 or 13, I think Buffett himself is only about 14% return over his lifetime. And he's the 5th wealthiest man in the world. So you don't need a lot to make it. You just need the time, and most people are impatient. So this has been a review of ASML. If you like this stock, throw a comment or not down below. Hit the subscribe, hit the like button. I really appreciate that. And if you want to see more of these stocks, check out my website. It's in the description, cashflowinvestingpro.com. We got a team of analysts. I've actually helped train analysts and get them jobs on Wall Street. If you're interested, I can help you do that as well. We publish regularly in the Cash Flow Club stocks like this that we think are very interesting. We have a whole probably over 100 stocks that we follow. And while there's never, there's not always a stock that's available at any instance. The market moves, and what we like to do is put out targets for what we believe a stock is really worth and let the market come to us. And then we know, hey, I've got this analysis. It's covering a decade. I feel reasonably certain that I could take advantage of this price when the market's melting down. Like we did that when we looked at Facebook a couple years ago when it was $70 a share. It's now $700 a share. So it's a 10x return. And we had a one-pager on it, called it a buy at that time. So take a look at the club. Tell me what you think. I'm happy to take questions. Let's review the 5 key factors here of this stock. So number 1, is it growing for revenue? Yeah, it's growing. The revenue is growing 18% annually. Our earnings, EBITDA earnings growing at 19%. Free cash flow, yeah, free cash flow is coming through strong. We got a high margin here, free cash flow. Low debt, yeah, debt is 0.5. And well priced, I'll say it is. The IRR here is sub 10. However, we've got some conservative assumptions. I don't expect the stock to drop too much because it is very in demand. I think it's a very interesting stock to add to portfolio over the long term. Let me know what you think, and thank you for the time. Have a good day. Bye-bye.